You are told just invest and relax. But what if the dollar weakens faster than your returns? That is how a melt-up can look like success while your buying power burns. If you have felt that in real life, you are not imagining it. You check your account, it looks higher, and you still feel squeezed at the store. You see headlines about record markets, and you still hesitate at the checkout. So what is going on? Let's name the idea first because it matters. A melt-up is when prices climb fast because money rushes in, not because life got cheaper. It feels like winning. It can also be a trap, because the thing that buys groceries is not your portfolio value, it is your buying power. Here is the uncomfortable question. If stocks rise 20% but your real costs rise too, did you actually get ahead? And another question you should answer honestly. In the last year, has your grocery total felt normal again? Or does it still feel like a punch? Now, zoom out with me for a minute. In 2025, you have had three big forces pushing and pulling at the same time. One, the stock market has stayed hot, powered by money chasing growth, and a lot of it tied to the AI story. Two, the dollar has had real weakness at points this year, and when the dollar weakens, imports can get pricier and global pricing pressure sneaks back in. Three, America's debt costs have moved into a new bracket, and that changes the whole mood in the background. That mix can create the great melt-up feeling. Numbers go up on screens while daily life stays tense. Let's make it personal, because that is where this hits. Picture your retirement plan like a bucket of future months. Mortgage, rent, groceries, medicine, insurance, car repairs. You do not retire on market vibes. You retire on checks you can count on. So if the dollar buys less, your retirement math shifts, quietly, month by month. Now, why would the dollar weaken in a year when markets can still rise? Start with the simple thing. Currencies move on rates, growth, and trust. When the US looks like it may cut rates sooner than others, the dollar can slide. When investors chase returns outside the US, they sell some dollars to buy other assets. When trade policy shifts and supply chains get tense, markets can wobble, and currency moves can get sharp. In 2025, even mainstream market research has described a broad period of dollar softness, especially earlier in the year. Now look at the dinner table side of this. Food prices did not magically reset because you saw a good month. The official inflation reports still show food up over the year, and some categories have stayed stubborn. So if you are a mid-aged worker or a retiree, you can end up in the worst middle zone. Your savings account earns something, but not enough. Your investments rise, but the cost of living stays tight. Your wages move, but your bills move faster. That is the moment where a melt-up feels like a joke. Here's where it gets more serious, because this is not only about prices, it's about stability. America is paying close to $1 trillion a year in net interest on the debt in fiscal year 2025, depending on the measure used. That is not a small line item anymore. Think about what that does to the future. When interest costs rise, it crowds out other choices, or it drives more borrowing, or both. Either path can pressure confidence, and confidence is the hidden beam holding a currency up.
Have you ever looked at your own credit card interest and thought, this is a trap? Now scale that feeling to a country. That does not mean debt default tomorrow. It means the system runs hotter, with less room for mistakes. So let's talk about the phrase people keep throwing around, de-dollarization. You've heard it framed like this. BRICS is creating a currency. The dollar is finished. America is done. That makes great thumbnails. It also mixes real trends with fantasy. What is real is this. Some countries want to reduce their exposure to the dollar system, especially when sanctions are part of global politics. There is more trade settled in local currencies in some places. That is a shift in behavior, not a sudden switch. What is not real, at least right now, is a clean, unified BRICS currency that replaces the dollar worldwide. Even analysts who take the push seriously still point out major hurdles and competing interests inside that group. So here's the honest version. The dollar can weaken without dying. It can lose some share at the edges while still being the main backbone. And that slow grind still matters because it can show up as higher import costs, higher commodity pricing pressure, and more volatility. Now bring in the other pressure point people ignore. Retail has been taking punches, and store closures are not a fun headline if you live in the places being cut off. When stores vanish, you lose local competition, local jobs, and easy access. That can raise prices in a practical way, even if inflation cools on paper. Some 2025 analyses tracking closures reported thousands of closures in just the first half of the year. If you live in a smaller town, you already know this story. A big box store cuts hours, then closes. The pharmacy counter disappears. Now a routine refill turns into a long drive. That is not a theory, it is daily life for a lot of people. So here's the question. In your area, have you seen more empty storefronts than 2 years ago? Comment "more empty" or "about the same." Now, let's connect the dots to the melt-up feeling.
When investors get nervous about currency value, they often do something predictable. They try to own assets that can rise in nominal terms: stocks, real estate, commodities, even collectibles. It is not always greed. Sometimes it is fear. So money floods into markets. Prices rise. Headlines call it a boom. But if your real costs rise too, you are watching an odd show. People cheer higher asset prices while you pay more for basics. That is why a melt-up can look like success and still feel like loss. Now we need to talk about the one word that decides whether this ends as a party or a hangover. Confidence. Not confidence in a motivational way. Confidence in the dollar as a stable yardstick. If global buyers demand higher yields to hold U.S. debt, borrowing costs can rise. If borrowing costs rise, interest costs rise. If interest costs rise, the government has fewer easy choices. That circle can feed itself. You do not need a default to get pain. You only need a shift in the price of trust. And yes, trade policy can push on this too. In 2025, Reuters reported major market reactions tied to tariff actions and the global response to them. Here's the street-level version. A tariff can raise input costs. Companies pass some of it on. Costs rise. People feel it at the register. Then wages chase prices. Then prices chase wages. Then the central bank gets pressured. That can keep the whole system tense even while stocks climb. So when people say the market is up, stop complaining, they miss the point. You do not live inside the S&P 500. You live inside your budget.
What if your retirement is 5 years away? Your 401k looks better than last year. You feel relief for one day. Then your homeowner's insurance jumps. Your property taxes rise. Your grocery bill stays high. Your car needs repairs. Your medicine copay changes. You start to realize your plan depends on costs calming down, not only on markets going up. Because that is the emotional core of this moment. A melt-up makes people feel crazy. You look at the screen and think you should feel safe, and you do not. You feel like the system is telling you everything is fine, while your bank app tells a different story. And if you are tired of that feeling, you are in the right place. Here is the last "what if this happened to you" moment. What if the next year brings another wave of asset gains and another wave of living cost stress? Your neighbor celebrates a portfolio milestone. You quietly cut back on basics. You feel behind, even while you are doing the right things. That is how people lose hope, not from one collapse, from a long stretch of mixed signals. If you want more straight talk about money, markets, retail collapse, and the daily reality behind the headlines, hit like and subscribe. This channel is for people tired of being told everything is fine, while prices, jobs, and buying power keep shifting under their feet. And before you click away, tell me this: do you think the next big risk is a market drop or a slow grind where life gets pricier even during good times?